In the very near term, the U.S. Fed has lost control of the long interest rate. Silver stocks are one of the most volatile classes of stock on the planet. Renewed momentum in silver will occur as a consequence of renewed momentum in gold.
Kick the conversation off with silver because you've said you love to buy things that are hated. You sold a lot of your physical silver in the run up to triple digits to all-time highs. You rotated some of that into silver miners, which I want to get to later. But at these prices and with sentiment so low, are you looking at silver bullion as a potential buy again here?
No. In my speculative portfolios, the easy money's made on hate. And silver isn't hated. Some people who paid too much for it in January hate it, but the market as a whole doesn't hate it. When you and I first started talking, Jesse, 5 or 6 years ago, both for your own channel and for VRIC, silver was legitimately hated. The stuff was trading for about $20 an ounce. The youngsters who hurt themselves in the so-called silver squeeze were vituperative in their hatred for silver. You could look at any sort of social media discussion group, and if there were 20 comments about silver, 18 were people who were describing it as a 4-letter word. That was hate. In commodity markets, buying hate and being patient is the surest way to make a fortune. Silver isn't hated yet. It's disappointed. But there's still hope in the market. I look for a market where the people who were hopeful now despise the sector. And we're not even close to there with silver. I don't see them on sale. I don't see capitulation bargains. But I see some stocks that are arithmetically attractive. Which is to say, I see companies that are selling at discounts to my calculation of their net asset values, where they have sufficient development pipelines and they're generating sufficient cash that their net asset value will increase over the 3 to 5 year time frame, without any help from the silver price. The universe of silver stocks that are in my portfolio seem to be, from my point of view at least, discounting $37 to $42 silver in a $55 world. That's not an unattractive scenario to me. I believe that renewed momentum in silver will occur as a consequence of renewed momentum in gold first. In other words, I don't think that silver will be the first mover. I believe that the deterioration in purchasing power for the U.S. dollar will lead to the generalist investor coming back into the precious metal space. And when the generalist investor does, history teaches us that when that happens, silver begins to outpace gold.
If silver still has hopeful buyers, the biggest opportunity may not have arrived yet. Rick Rule notes that true commodity bottoms emerge only after widespread disgust replaces lingering optimism, a condition today's market still lacks. That's uncomfortable because many investors mistake disappointment for capitulation, while institutions quietly wait for emotional exhaustion. Chasing early rebounds can tie up capital before the real reset begins.
I'm not looking for this to happen anytime soon, but I also know that the silver stocks are one of the most volatile classes of stock on the planet. And should this circumstance come to pass, and I believe there's a probability that it will, I suspect I'll be ludicrously rewarded in a fairly short period of time, but that fairly short period of time may not happen for 2 or 3 years, which I'm comfortable with.
In terms of silver itself, then, do you think we could see further downside up ahead? Obviously, predicting prices is a mug's game, and I know you're a very long-term time horizon investor, which is why I love talking to you, because in my opinion, short-term price action is for entertainment purposes only. We're invested in silver, for example, in silver miners, because we see a long-term thesis playing out eventually. But in the near term, do you think we could get back to that $30 level in silver? And at that point, would you be stepping in to buy?
If you give me the use of the word could, I can sell you anything, Jesse. I believe that in the very near term, the U.S. Fed has lost control of the long interest rate, the 10-year and the 30-year rate. I think they'd like it lower, but I don't think there's much they can do about it. They can still control the short rate, but it looks like they've lost the long rate.
Markets often misprice businesses long before they misprice the metal they produce. According to Rick Rule, some silver miners already trade as if silver were stuck around $37 to $42, despite a much stronger long-term pricing backdrop. That disconnect suggests investors are discounting fear rather than future cash generation, creating selective opportunities instead of broad bargains. Patient portfolios benefit from arithmetic, not emotion.
If long bond rates continue higher, I think that's tough on precious metals prices. So it wouldn't surprise me that the balance of 2026 continues the trend in motion, which is to say lower. Paradoxically, I hope that's true. Although I have a portfolio that has a lot of physical gold and an awful lot of precious metals mining stocks, I believe the next 5 to 10 years will be extraordinarily good for that sector, and I want to buy more. Given the fact that I want to buy more, it's in my interest to have that stuff cheaper, not more expensive. It's wild when I hear discussions about precious metals at conferences that you and I have both been to, where people express a preference for the sector and then want it to be more expensive. It's like a kid that walked into a grocery store and asked the grocer to increase the price of a candy bar from $1 to $1.25. He wants the candy bar. Why would he want to pay more for it? I think you have to keep cash on the sidelines because I think there's a possibility. Notice I didn't say a probability. I said there's a possibility that we could face a liquidity-driven shock in equities markets, a la 2008. I don't think this is a probability, certainly not a certainty. But I think there's, say, a 25% probability that in the next 2 years, we could experience a 50% decline in equities markets. And when you experience that broad-based decline, the tertiary equities, the marginals, fall farther than the rest. There's no industry in the world more marginal than junior mining. So having some cash set aside in the off chance that there are stupendous rather than relative bargains is something I've chosen to do. In the 2008 crash, I came into that crash by then as a fairly experienced investor, and I had a lot of liquidity. And the consequence of that is that not 2008, but rather 2009 was easily the best investment year of my career. I had the tool, the cash, and I had the courage from education to take advantage of it. So I'm maintaining fairly large amounts of liquidity, not making a market call per se, but really gambling against the possibility rather than the probability that we have a decline. And it's expensive, Jesse, to maintain liquidity.
The smartest portfolios often look underinvested just before markets break. This is where Rick Rule's thesis shifts from chasing returns to preserving optionality. When forced selling creates irrational prices, institutions understand liquidity becomes its own asset during market panics, while retail investors are usually fully exposed. When bargains finally appear, cash may seem unproductive today, but flexibility can become the highest returning position tomorrow.
Most investors look at it in terms of the opportunity cost, which is to say, if I had had this money in the market, I would have made X, Y, Z. That's looking at it incorrectly. The correct way to look at it is the money that you get paid in interest relative to the deterioration in purchasing power of the currency. If you believe, as I believe, that the US dollar is experiencing an 8% compound decline in purchasing power and other currencies are doing worse, you need to understand that if you're getting paid 4.5% owning a bond, you're not making 4.5%, you're losing 3.5%. So maintaining liquidity has a real cost. I believe that the best way to think about that cost is an option on having the liquidity to take advantage of liquidity squeezes when other people are taking advantage of.
Central banks are still buying. Government debt and deficit situation isn't going away. Currencies continue to depreciate. Trust in government institutions crumbling by the day, along with all the other tailwinds behind the sector also looking strong. Is this a time to be adding to the gold stack or perhaps establishing a position for those who don't yet have physical gold? If you were to enter the sector today, what are your thoughts?
Yeah, I think you have to. Your listeners may not have to because they have probably done it over the last 5 years. But the fact remains in the U.S. market, the market I understand best, that the market share of precious metals and precious metals related investments relative to all other savings and investment classes is only 0.5%, which is to say in the U.S. market, precious metals and precious metals related assets comprise less than 0.5% of total savings and investment assets. This is silly. I mean, this is truly silly. The 4-decade mean is 2%. If you had reversion to mean, you would quadruple demand for precious metals related assets in an economy that's 24% of the world economy. This is truly wild. Now, I'm of the belief that that precious metals likely trade sideways for the balance of 2026. Higher U.S. interest rates and more recently higher Japanese interest rates have meant that it's more expensive to own gold than it used to be. And it also increases the relative attractiveness of bonds, another traditional safe haven. I happen to believe that the long bond game is a mugs game for reasons that we've already discussed, but that doesn't matter. The bond market is much bigger than the gold market, and right now seems to be doing better as a consequence of the interest rates. And it wouldn't surprise me to see that circumstance continue through at least the balance of 2026. I certainly hope it's the case. I save systematically in gold, and given that that's the case, I would rather pay less than more.
Are you seeing any attractive bargains when it comes to the biggest and the best gold producers at present? I mean, we saw Agnico Eagle, for example, report record Q1 earnings and proceed to drop, 20% from there or something like that. The majors who are essentially printing cash in this gold price environment are all taking a hit. What are your thoughts there on those big producers and on the royalty streaming side of things as well?
Agnico, Franco, and Wheaton have been crushed, which I think for most investors is a gift from God. I think the beta that we will enjoy in the gold sector over the 5 to 10 year time frame is so big that you don't need to chase alpha. I would define beta as the outperformance of the gold sector relative to the broad market. You could buy the best of the best and not take any single company risk or operating risk whatsoever. And you can buy it at really, really, really attractive arithmetic multiples. I would be doing that myself hand over fist, except for I've been doing it hand over fist for 5 years. I've chosen now, because we are, with regards to mining stocks, in a risk-off environment, I've chosen to take more risk in my portfolio for various reasons. But I'm not suggesting that your listeners who are unwilling to do as much work as I am willing to do, or unwilling to take as much risk, for most investors, buying yourself a package of Wheaton, Franco, and Agnico Eagle, and then reading books you like, looking after your garden, playing with your kids or your grandkids, it's the right course of action. It's only the freaks like you and I that need to come farther down the quality train and get in the way of later money.
Well, to be clear, I don't go down that quality train. I stick to the big producers and the ETFs for the gold and silver space. I want to switch and finish things off with a discussion on investor psychology, because we're seeing all this volatility in markets, capitulation on social media, insider trading and market manipulation by the political class and other insiders. Obviously, the war raging, markets moving one way or the other, depending on what President Trump posts on Truth Social that day. I wonder if you could speak to how we can keep our heads on straight, ignore the noise, and stay focused on what really matters as investors and speculators.
Well, I think, first of all, listen to what you just said. You look at the panoply of risks in the world. I hate to personalize it, but Trump, various ones. The greatest risk that you face, Jesse, is to the left of your right ear and to the right of your left ear. If you focus on that risk, you minimize all the other risks. And the way that you do that is that you declare war on the way you feel. It's important as an investor that you think as opposed to feel. It's important that for the most part you ignore news. Don't trade on news. unless you understand the news well enough that you're past the headline, that you think about the implication. Because, Jesse, you can never know when whatever the Iranian Ayatollah and the Israeli Ayatollah and the American Ayatollah decide to end hostilities. You never know. You can never know the outcome of that. The idea that you have the ability to trade the news in the Gulf is zero. But you feel the headline. You feel the fear. You look at the day-to-day price action, you think there's information there. There's not. There's no information there. There's entertainment there. If you get beyond that to think about the implications of the war in terms of, as an example, structural demand for uranium, that gets you into the realm of thinking, not feeling. The second thing is, don't believe in the tooth fairy. Don't believe in something for nothing. Don't believe that you can engage in speculation if you aren't willing to tolerate volatility and real risk, and if you aren't willing to do the work. And the third is that the greatest financial edge on history is compounding. It's simply time. Buffett said that he made most of his fortune by sitting, not thinking. He said in one of his missives to shareholders that he searched for investments that demanded of him sloth and lethargy, both of which he had in abundance. I think that's very, very important.